A one-time investment of $10,000 in 2003 would have turned that $10,000 into $323,000 by August 21st. And more importantly, that $10,000 in original investment would have generated $73,634 in income. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I'm going to be looking at a company today that really is kind of a very interesting company because I believe it's attractive if your strategy is income, and I also believe it's interesting if your strategy is growth. And best of all, I think the company can be bought today at a very attractive valuation. The company, of course, is Cummins Inc., which is the world's largest diesel manufacturer. So let's go ahead and go into FastGraphs and let's see if we can look at it from the point of view of its metrics historically. Now, what I've got on here is I've got adjusted operating earnings. Now, for those of you who are subscribers to FastGraph, I want to show you something that's very important. If you notice, adjusted earnings growth was anomalously high in 2003 and 2004, which really distorted the long-term growth rate. So the first thing I would do is I would ask you to shorten the time frame to like the last 20 years, which includes 2.5 years roughly of estimate data, and you get a little better picture. This has been a double-digit grower. I would say 10 to 12% would be the number that I would look at for Cummins. Now, Cummins is semi-cyclical in that you'll notice it did have a drop in earnings in the Great Recession, had a couple of moderately down years in 2012 and 13. And then it had some really strong growth in 2017, 18, and 19. And then COVID came and it had a down year. And now growth is being projected to be very strong. What I really want you to notice about this, with a lot of volatility in between, how the company's stock price has tracked the earnings. The orange line on this graph, for those of you who aren't familiar with FastGraphs, represents a valuation reference for intrinsic value. The blue line is simply trimmed average of how the market has valued the stock. So you're looking at PE ratios between 14 to 15 here. Anywhere you touch this blue line, it's a PE of 13.95. Anywhere you touch this orange line, it's a PE of 15. So what this tells me, if I analyze this, just running my eyes across here, anytime I can buy this below 14 or 15 times earnings, like here, when the PE got down to 5 or 6, or here when the PE got down to 11 or 12, here when the PE got down under 10, and so on, would have been the optimum times to buy the stock. Today, the blended PE is 12.68, okay, which is below the market normal and also below the theoretical intrinsic value. So the stock is at a bargain, and it does offer a margin of safety. It offers a current yield today of 2.88%, which makes it attractive for income investors. It's A+ rated, has very moderate debt, a very strong balance sheet, and the only real negative about the company would be the moderate cyclicality of the earnings over time, because obviously it's the world's largest diesel manufacturer, and it's involved in a lot of other what I would call heavy machinery type businesses as well. We'll look at that very briefly here, but I want to stay on the metrics. Now, one of the metrics that I really like to evaluate stocks with is EBITDA, which is actually a form of cash flow. As Buffett said, it's earnings before all the bad stuff, but it's earnings before interest, taxes, depreciation, and amortization. So there's a lot of non-cash charge type stuff that's being excluded here. And what you're looking at here is really a decent form of cash flow. And what I want you to notice is how clearly EBITDA as a metric gives us the opportunity to buy this stock when it's inexpensive, because we clearly see the times when it is. And also, it shows us bad times to buy the stock when the stock is trading at a premium valuation. For example, in April of 2021, the stock was trading at a price to EBITDA of about 15.7. Its normal price to EBITDA is only 9. It's a little different than what we saw with earnings. The company is expected to have very strong EBITDA growth this year, but it's expected to be flat the following year and then grow by 7% again. But the point is, the stock is trading at a significant discount to its normal intrinsic value. And this is an extremely high-quality company. Now, despite the fact that the earnings have been somewhat volatile over time, nevertheless, they've tracked the company's EBITDA in this case, or the company's operating results. The price line has been, somewhat volatile, but I want you to notice the dividend line. This company has increased its dividend every year for 18 years. It's a dividend contender and on its way to being a dividend champion, in my opinion. A very high quality level of dividends. I want you to notice that EBITDA covers the dividend. EBITDA, in other words, is a lot higher than the dividend. If I'm looking at just pure cash flow, operating cash flow, it's a little more cyclical than EBITDA, but also it covers the dividend. And even, today, we're looking at operating cash flow payout ratios of somewhere between 25 and 35%. Free cash flow had 1 year where we got a little bit close to it. That was 2022, where we had a couple of down years with free cash flow is expected to increase dramatically. So I really like the company from a standpoint of valuation. I really like the company from a standpoint of dividend growth. I really like the company from the standpoint of a margin of safety. All right, now if I'm looking at it from a standpoint of operating earnings here, and I go into the forecasting calculator, the company is expected to grow earnings by 27% this year, and it's very widely followed with 25 analysts. And I want you to notice the estimates have actually been increasing for the year. At 2024, it's expected to earn $20.06, a rather flat year, just moderately above what 2023 was. But again, the estimates have increased, over the last 6 months pretty dramatically. But then it's supposed to grow by 11% again in 2025. So all in all, this averages out to be about a 12.48% growth rate. The long-term growth rate is expected to be 12.49. Now, when I talked about the track record of this company, I want to make a point now. That track record was generated when the company grew earnings by 11%. Both near-term forecast of 12.48 and the long-term forecast of 12.49 is above that. I also want to point out the stock would have been bought in 2006 at an 8.7 PE, so there was an undervaluation factor. Now, the performance is still very good over this time frame, but a little different than what we saw on the longest time frame. Here, a $10,000 investment would have thrown off almost $22,000 in income, and it would have grew your $10,000 to $98,000, soundly beating the S&P 500, no matter how you measure it, versus income and or if you're looking at capital appreciation. Okay, now part of that, as I always like to point out, the components. We got some PE ratio expansion. We had a PE ratio of 9.06 that currently has expanded to 12.08, which, though, is below the 15 PE ratio or the 13.95. So we do have a margin of safety here. So the point is, future growth is expected to continue as it has in the past, which, kind of makes this a relatively attractive investment. The only real negative here, if you want to call it a negative, would be the analyst scorecard. Analysts have missed earnings about 33% of the time on a 1 year forward, but they're much better over 2 years. So even though they miss earnings over the short run, they tend to recover as you go into longer runs. And the misses have been relatively benign over time. But generally speaking, this is a cyclical company, and I think if you're going to invest in this stock, you want to take that into consideration. All right, the fact that you could get periods of time where you would see some price volatility. But if you're buying the stock at a discounted valuation like this, almost any time you'd have bought this stock at, let's say, a 12 PE, you'd have been in pretty good shape going forward. Okay, you would have, even though you've had periods where the valuation dropped, you still would have been making money if you held it, through those time frames and even with a little bit of a recovery. But over the long run, the power of compounding really kicks in, and this stock generates some very, very, super returns. Now, I do believe in research and due diligence. Zacks has this company set as a 3 or a hold. They give it a B for growth, an A for value, and a D for momentum. And the D for momentum is why they call it a hold. I want to make that point. That's because the stock has been down, but I think this is a classic opportunity. This may not be the very, very bottom for the stock. It was down slightly yesterday. It's up the last I looked ever so slightly today. Yeah, up 15.15%, up 34 cents. So, it's, again, going to be volatile. This may not be the best time or the lowest point that you can buy. The stock could drop a little more, especially considering a flat year next year. But I think if you start building a position in Cummins today, you'll be fine. I love the fact that they have low debt. I love the fact that they're A+ rated. I love the fact that they offer almost a 3% dividend yield. And I love the fact that the dividend has consistently grown year after year after year for 18 years in a row. Now, we can just take a quick look at the company's financials. And what I'd like to do is go into the financial statements here. And I want to look at the income statement. I want you to notice that sales growth has been very strong, averaging about 6.8%. Now, cost of goods have been increasing. The company's made several acquisitions recently, so we see some acceleration in depreciation and amortization, and selling and general and administrative expenses have also increased. Now, that's putting a little bit of pressure on the margins, but the company still generates very, very good margin relative to its industry. And, its most recent margins in 2022 were above industry standards. Its gross margin, its operating margin was above standards, and its net margin was a little bit below that because they do have a couple of divisions that are causing them some problems. And Zacks talks about that in their report. If you have access to this, you might want to look at Zacks. And that is their Accelera segment is suffering from continued losses. And if you go into the company and go into their website, you will be able to review what Accelera does. Accelera is in hydrogen production, buses, trucks, stationary power, boats and parts, mining, and retail. But it's basically alternative energy, zero emission type energy. Now, it's causing them a little bit of problems currently, but I think the future is very, very strong. They did an earnings presentation on August 3rd, and I think this is worth spending some time on. It shows that, their gross margin as a percentage of sales went down slightly. Their EBITDA, did increase. EBITDA as a percentage of sales decreased just a little bit. You can go down here and go through this report. One thing I like a company that breaks out, where their businesses are. Their guidance is very, very good for the, going forward for the next, for the full year for this year. As I told you, as I showed you earlier, they're expecting a big year. Their revenue is expected to increase. Their margin is actually going to still be double digit, which is, I think, important. You can go down here and look at all the different segments of the company, and they break all that down. And I do like later here in this presentation, they give you all the different revenues by the different segments. You can see their component segment is, their biggest. The Accelera segment, even though it's, generating losses right now, is actually still a very small portion. Their engine segment is big, their power systems and distribution. And then you can also see all this by revenues from, market. It's different markets. Obviously, the U.S. and Canada is their biggest market. Bottom line is, I really like this company as a result of its quality, its growth potential, and as well as its income potential. So I think it's a kind of company that can fit in anybody's portfolio, whether you're looking for income, growth, or whatnot. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Hope you enjoyed this video on Cummins. It's a great business. It is a little cyclical. That's the caveat I would put out. You need to be prepared for some volatility if you're a long-term investor in this company, but now would be an interesting entry point. And if it got any cheaper, I would be aggressively buying this stock. I hope you enjoyed the video. If you did, give me a like, subscribe to the YouTube channel, and also take a look at subscribing to FastGraphs. What a great tool that can really help you evaluate, whether stocks are reasonable purchases or not, and do it just in an instant. And by the way, I'm going to put a shout out to Ari Gutman. He did an interview with us. We're going to put a link at the bottom of this video. It's about an hour long. If you're interested in learning more about my philosophies on investing, it was an interview that Artie conducted, about me and my history in the business and my philosophy and my strategies, etc. So, those of you who've been following me for a long time might find that interesting. I think Artie did a great job on the interview, and it'd be great to go ahead and give him a little shout out by going to his video. Follow the link that's below here and watch it. Thanks for watching. We'll talk to you guys again real soon.